A generation ago, a typical salary could support a mortgage. Today, even two-income struggle to qualify. That shift didn't happen because young people changed. It happened because housing changed. The question isn't, why are young people failing? The real question is, what changed in the structure of housing itself? Most people assume housing is expensive due to inflation. Prices go up. That's normal. But general inflation explains part of the increase, not all of it. Housing didn't just rise, it accelerated. In many major cities, home prices have grown between 2 and 4 times faster than wages. When asset prices outpace income growth, affordability collapses even if the economy is strong. So the issue isn't just inflation, it's asset inflation. Wages grow slowly. They adjust through negotiation, through productivity, through job switching. Asset prices move differently. They respond to interest rates, credit availability, investor demand, liquidity. When central banks lower rates, borrowing becomes cheaper. Cheaper borrowing increases purchasing power. And in housing, purchasing power determines price ceilings. So prices rise, not because homes improved, but because buyers can borrow more. For decades, interest rates trended downward. Lower rates made mortgages cheaper. Cheaper mortgages increased purchasing power. When rates fall, buyers can afford larger loans, even if their salaries don't increase proportionally. So prices rise, not because homes improved, but because borrowing power expanded. This created a long period where housing appreciation felt natural. But what was really growing was credit capacity. When money becomes cheaper, assets become more expensive. And housing is the largest asset most people buy. Housing is not just shelter, it's collateral. Mortgages create money. Every new loan expands liquidity. When credit expands, more buyers enter the market. When more buyers enter, prices rise. As prices rise, banks are willing to lend more because the collateral value increased. That feedback loop amplifies growth. Housing doesn't just reflect economic expansion, it amplifies it. If prices fell dramatically, the entire credit structure weakens. Banks hold mortgages as assets, pension funds hold mortgage-backed securities, developers rely on projected valuations. A significant, sustained drop in home price will threaten balance sheets. So policy tends to stabilize housing, not deflate it. Interest rates adjust, liquidity flows, supply slows. The goal isn't cheap housing, it's financial stability. Historically, housing was primarily owner-occupied. Today, large investors participate heavily. Private equity, institutional landlords, short-term rental platforms. Homes are no longer just residences. They are yield-producing assets. When assets generate yield, they attract capital. Capital increases competition. Competition increases price. This shifts housing from a local market to a financialized one. And financialized assets rarely become affordable again. Housing is no longer purely local. In major cities, buyers are not just neighbors, they are global investors. When capital flows across borders, local wages no longer determine pricing. Global liquidity does. A home in a city is no longer valued only by local incomes. It is valued by global demand for safe assets. This disconnects housing from local affordability. Young buyers compete not just with peers but with capital. You will often hear, there isn't enough supply. That's true, but incomplete. Supply is restricted by zoning laws, infrastructure limits, financing cycles, developer risk tolerance. Developers build when prices justify risk. If prices weaken, construction slows, which prevents oversupply. So even supply constraints often reinforce upward stability. Timing matters more than effort. Previous generations bought into markets before financialization accelerated. Before rates fell for decades, before global capital entered housing, younger buyers entered during higher baseline prices, tighter credit standards, investor competition. They are not less capable. They are entering a different structure. Even if mortgage payments are manageable, down payments are not. When homes cost 6 to 10 times annual income, saving 20% becomes a multi-year process. Meanwhile, rising rents reduce saving capacity, so the entry point moves further away each year. Housing no longer scales with income, it scales with asset access. Rising housing prices create wealth for owners. That wealth becomes collateral. Collateral allows further borrowing. Borrowing allows additional asset purchases, which increases demand, which raises prices again. Meanwhile, those without assets save from wages alone. Wage saving is slower than asset appreciation, so the gap widens over time. Housing inequality compounds, not because wages fell, but because assets accelerated. In previous decades, renting was transitional. Today, for many, it feels indefinite, because asset appreciation benefits owners, not renters. When housing rises, owners build equity, renters build history. That widening gap creates generational divergence, not because of work ethic, but because of positioning. Housing supports bank balance sheets, retirement funds, consumer confidence, local government revenue. Stable or rising housing price anchor the broader economy, which means large, permanent deflation is politically and financially undesirable. Affordability is a social goal. Stability is a financial requirement. Stability usually wins. The housing crisis isn't simply about greed. It's about structure. An economy built on expanding credit cannot easily tolerate falling asset prices. And when housing becomes an asset class, access becomes more important than effort. So young people aren't failing. They are navigating a system that prioritizes asset stability over entry affordability. Governments attempt to intervene, subsidies, tax credits, first-time buyer programs. But many of these policies increase demand, not supply. Increased demand in a constrained market pushes prices higher, so solutions often unintentionally reinforce the problem. The system favors stability over reset, and housing stability means price support, not price reversal. Previous generations built wealth primarily through appreciation. They entered housing markets before large-scale financialization, before global capital flows, before decades of falling interest rates. Their leverage multiplied in a rising asset environment. Younger generations enter at elevated price levels with tighter credit and higher debt burdens from education. The leverage works differently now. Higher prices mean higher loan sizes. Higher loan sizes mean higher sensitivity to interest rates. Even small rate increases reduce affordability sharply. So entry timing matters more than effort. Housing used to reward participation. Now it rewards early positioning. And the difference between early and late entry is measured in decades of compounding. Affordability is not just mathematical, it's psychological. When buyers believe prices will continue rising, they stretch. When they believe prices may fall, they wait. That expectation shapes market cycles. But when long-term policy signals that housing will be supported, confidence remains. And supported confidence keeps price floors intact. So the market rarely resets completely. It cools, it pauses, but structural deflation remains rare. The housing challenge is not solved by individual discipline alone. It is shaped by credit expansion, asset prioritization, policy stabilization, capital mobility. When housing becomes financial infrastructure, affordability becomes secondary to stability. And until that structural priority changes, young buyers are not competing against effort. They are competing against liquidity. Housing used to reflect income. Now it reflects liquidity. And liquidity expands faster than wages. Until that relationship changes, affordability won't be solved by budgeting. It will be shaped by policy, credit, and positioning. And the question for the next decade isn't will houses get cheaper? It's who will be positioned to own them.